Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. Let's jump in. And first up, we begin in North America. Confidence among US home builders fell in August, matching the lowest level in nearly 2 years, as high mortgage rates continue to weigh on demand. The National Association of Home Builders and Wells Fargo Index of Housing Market Conditions slipped 1 point to 32, contrary to expectations from economists for a modest improvement. The decline highlights the industry's ongoing struggle to attract home buyers despite a slight easing in mortgage rates to 6.667% earlier this month. Rates remain more than double their late 2021 levels. To counter hesitant buyers, builders are leaning more heavily on incentives. The share of firms offering sales sweeteners climbed to 66%, the highest level since the pandemic, while 37% reported cutting prices. Quote, given a slowing housing market and other recent economic data, the Fed's Monetary Policy Committee should return to lowering the federal funds rate, end quote, the National Association of Home Builders chief economist said, arguing that cheaper financing would ease construction costs and indirectly reduce mortgage rates. Builders also face mounting competition from the resale market, where inventory has climbed above pre-pandemic levels in parts of the South, Southwest, and West. Persistent supply-side bottlenecks, including land use restrictions and development delays, remain another drag on the sector. Meanwhile, while we're still in the United States, the Trump administration is considering taking a roughly 10% stake in Intel Corp, a move that could make the US government the chip maker's largest shareholder, a historic move by the US government. The potential investment would involve converting a portion of Intel's $10.9 billion in grants under the 2022 CHIPS and Science Act into equity. At current market value, a 10% stake in Intel would be worth around $10.5 billion. Officials stress that discussions remain preliminary and the size or structure of the stake could change. The White House spokesperson declined to discuss specifics, saying only that, quote, no deal is official until it's announced, end quote. The Commerce Department, which oversees CHIPS Act disbursements, has not released any details in the last few days. The administration is also examining whether to convert other CHIPS Act awards into equity stakes, though it remains unclear if this approach will extend beyond Intel. The move would echo recent government interventions in strategic sectors, including the Pentagon's $400 million preferred equity purchase in MP Materials Corp., a rare earth producer. The talks come as Intel struggles with stagnant sales and technological setbacks against Taiwan Semiconductor Manufacturing Co. and Samsung Electronics. New CEO Lip Tan has emphasized cost-cutting to stabilize the business. Intel's shares initially surged on optimism about government support, but slipped 3.7% on yesterday, after reports of the equity discussions. Both the Trump and Biden administrations have prioritized reviving US semiconductor manufacturing, viewing Intel as critical to building advanced chips domestically. Next up, we move to Europe. Oil prices slipped on Tuesday today as traders weighed the prospect of renewed diplomacy to end the war in Ukraine, with US President Donald Trump pressing for direct talks between Russian President Putin and Ukrainian leader Zelenskiy. Crude fell towards $66 a barrel after gaining 1.1% in the previous session, while West Texas Intermediate traded near $63. The pullback came after Trump phoned Putin, urging him to begin preparing for a face-to-face summit with Zelenskiy, following the US president's White House meeting with the Ukrainian leader on yesterday. The flurry of diplomacy marks a sharp turnaround for Kiev, which appeared sidelined just days earlier when Trump met Putin in Alaska and suggested Ukraine bore responsibility for ending the conflict. The US president has since floated the idea of a trilateral gathering following a bilateral summit between the Russian and Ukrainian leaders. Late Monday evening in the United States, following a day of intense diplomacy, the US president wrote on social media that America would provide, quote, coordination, end quote, for Europe's security guarantees, but he stopped short of a full-throated commitment of US military support for Ukraine. The US president said that the US would be, quote, involved, end quote, in helping Ukraine defend itself, but that the burden would mainly be on Europe. Market analysts say a ceasefire could carry significant implications for oil flows, particularly if it leads to increased crude shipments from Russia. Quote, crude may be in for a holding pattern, end quote, said Vandanahari, founder of Singapore-based consultancy Vanda Insights, adding, quote, the path to resolving the conflict has opened up, but could be a long one. End quote. Despite diplomatic overtures, fighting continues. Ukraine said Monday it'd carry out another strike on Russia's Druzhba pipeline system, halting a vital supply route that delivers oil to parts of Central Europe. German Chancellor Friedrich Merz, who attended the White House discussions with Zelenskiy, suggested a Putin-Zelenskiy summit could take place within 2 weeks. Zelenskiy described his talks with Trump as his, quote, best meeting yet, end quote, with the US president. For traders, much hinges on whether a ceasefire alters the sanctions regime. While Trump recently tightened economic penalties on India from buying Russian oil, China, the largest overall importer, has so far been spared from so-called secondary sanctions. Even with geopolitical risks elevated, crude remains more than 10% lower this year. Markets remain pressured by concerns over the global economy, the drag on US trade policies, and the potential for oversupply as OPEC Plus continues to restore output. With diplomacy and conflict unfolding in parallel, oil markets face heightened volatility as investors await clarity on both geopolitics and supply dynamics. And finally for today, we move to Asia. Thailand's economy grew faster than expected in the second quarter, but officials warned that structural weaknesses and US tariffs pose mounting risks for the export-dependent nation. Now, before we jump into this development, if you're enjoying today's episode of Market Update, don't forget to hit the like button, and if you would like to continue to be on top of the most up-to-date analysis on the biggest moves in the world's most important markets, consider subscribing. Hit the bell notification icon and you will be. Gross domestic product in Thailand expanded 2.8% in the 3 months through June from a year earlier, according to data released yesterday, Monday, by the National Economic and Social Development Council. The result edged past the 2.7% median forecast, though it marked a slowdown from 3.2% growth in the previous quarter. Quarter-on-quarter growth stood at 0.6%, also slightly above expectations. Analysts said exports were the bright spot, offsetting weak domestic consumption and faltering tourism. Thailand's biggest challenge lies ahead. The US, its largest export market, has imposed a 19% tariff on shipments, a rate in line with most Southeast Asian neighbours. Still, officials warn that Thailand could lose market share in key industries including electronics, machinery and auto parts. A government spokesperson yesterday told reporters, quote, the impact of US tariffs is the biggest challenge for the Thai economy. We're still facing a risk of losing market share in some products. Our effective tax rate is still higher in some categories, so we need to adjust ourselves. End quote. They noted that Thailand is better positioned in rice, rubber, motorcycles and raw pet food, but vulnerable in higher value goods such as hard disk drives and telephones. Thailand's long-standing structural issues, low productivity growth and over-reliance on exports are limiting its potential. The National Economic and Social Development Council chief said yesterday, quote, the Thai economy has structural problems, so it's hard for us to have high growth at our potential level of around 3%. The US tariffs may help accelerate our economic reform. End quote. That assessment echoes warnings from credit agencies. Moody's said last week that limited progress on reforms, combined with political instability and global trade risks, threaten Thailand's growth outlook and fiscal health. Domestic instability has further clouded the outlook, with the Prime Minister suspended and deadly border clashes with Cambodia weighing on sentiment. Bangkok also cut its forecast for Chinese tourist arrivals to 4 million this year, down from 6 million, as more travellers opt for Japan and other destinations. So far, the National Economic and Social Development Council raised its 2025 growth forecast midpoint slightly to 2%, helped by better-than-feared tariff terms. The Bank of Thailand, meanwhile, is expected to cut interest rates again in October to cushion the economy as front-loading of exports fades and tourism struggles to recover. Still, whether these pressures will push Bangkok to make the necessary but painful political and economic reforms needed to maintain higher growth continues to be an open question. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Tuesday, and I will see you for another episode tomorrow.